Let me show you something. Right now, a gallon of gas in America costs $4.48. 3 months ago, $2.98. That's $1.50 extra every single time you fill up. $75 a month, $900 a year, gone. And it's not just gas. Amazon slapped a surcharge on your Prime deliveries. JetBlue raised ticket prices mid-booking. Your grocery bill is up. Your electricity bill is up. And economists at Moody's are using a word that should terrify you. Stagflation. Higher prices, slower growth at the same time. Now, here's what nobody's connecting for you. This isn't about the war itself. This is about one narrow strip of ocean, 21 miles wide, sitting between Iran and Oman, called the Strait of Hormuz. And right now, the entire global economy is being held hostage by it. But here's the thing. Trump just signaled a peace deal might be days away. And if that deal happens, $20 trillion worth of global money is about to move. The question is, where does it go? And are you in the right place before it does? Why should you watch this video? Because right now, every single day, you're getting a piece of news. Ceasefire imminent. Then 3 hours later, talks collapse. Oil spikes. Then oil crashes. Then spikes again. And most people are just watching, paralyzed, confused, waiting for someone to tell them what to do. That paralysis is costing them money. My name is Moon. I'm obsessed with understanding how geopolitical events move money, where capital flows, why it moves, and who captures the upside. If you're watching this wondering, what actually happens to oil when this war ends? Where does money go? And what should I be doing right now? Then hit subscribe, because this video is exactly for you. Here's what I'm going to walk you through. Where is the money flowing right now and why? Who's pulling the strings on these oil prices? And where does the smart money go when peace breaks out? Let's get into it. Okay, first, you need to understand the physical reality here. Because most people think about this war in terms of bombs and politics, but the real story is about a pipe. The Strait of Hormuz is the world's most important energy pipeline, except instead of a pipe, it's a 21-mile wide strip of ocean. Every single day, 20 to 21 million barrels of oil flow through it. That's 20% of all the oil traded on Earth. Let me give you the other side of that number. The entire U.S. Strategic Petroleum Reserve, the emergency stash the government built up over decades, holds about 372 million barrels. That sounds like a lot, until you realize the world burns through that in less than 18 days. So when Iran closed the strait, what happened? The International Energy Agency called it, and I'm quoting them directly, the largest supply disruption in the history of the global oil market. Bigger than the 1973 Arab oil embargo. Bigger than the Gulf War. Bigger than anything we've seen before. And the market reacted accordingly. Brent crude blew past $120 a barrel. WTI touched $113. U.S. gasoline hit $4.48 a gallon, up 50% since the war started. But here's what's wild. America produces more oil than anyone, over 13 million barrels a day. America is the world's largest oil producer, and American consumers are still getting crushed. Why? Because oil is a global commodity priced on global supply. You can't just buy your own oil at a discount. When the global price goes up, your price at the pump goes up. Period. And that's the trap the U.S. walked into. Here's where it gets interesting. Every crisis creates winners and losers, and the money flows from the losers to the winners instantly. The instant winners when the war started: energy companies, Exxon, Chevron, Shell, defense contractors, Raytheon, Lockheed Martin, Northrop Grumman, tanker companies. Because stranded tankers waiting near Hormuz were suddenly worth a fortune. The instant losers: airlines, Delta, United, JetBlue. Their fuel bill is their biggest cost. Jet fuel is up more than $2 a gallon since the war started. Delta's CEO went on CNBC and said they're raising fares, and demand is still holding up. But analysts know this can't last. Shipping companies, Amazon, UPS, FedEx, all adding surcharges because diesel is through the roof. And who else is losing? The American consumer. And here's the number that should shock you. Consumer spending drives 68% of U.S. GDP. When gas prices go up $1.50 a gallon, American families cut back on restaurants, vacations, clothes. That spending pullback flows straight into slower GDP growth. Mark Zandi, chief economist at Moody's, said, "Consumers threaten to be hammered by the surge in oil prices. Inflation will quickly accelerate, cutting into purchasing power and hitting consumer spending, GDP, and jobs." And now the Fed is caught in a nightmare. Before the war, they were expected to cut rates. Now, former Fed Chair Janet Yellen is warning that economic growth will suffer and the Fed's job of containing inflation will get much harder. The market was actually pricing in a rate hike at one point, not a cut. Think about what that does to mortgage rates, car loans, credit card debt. That's the ripple effect nobody's talking about enough. Now I'm going to tell you what Wall Street is actually terrified of. And it's not the war continuing. It's what happens after the war ends. Here's the scenario nobody wants to say out loud. Trump makes a deal. Hormuz opens, oil drops, gasoline falls back to $3.50. Everyone cheers. Markets rally. Trump declares victory, but then 30 to 60 days later, the world realizes something. Strategic petroleum reserves are almost empty. The US, Europe, Japan, they all drain their reserves trying to cap prices during the war. The moment the strait reopens, every single country on Earth tries to refill their reserves. At the same time, you've got 230-plus tankers that were stuck in Hormuz finally moving oil. But you've also got every government on Earth suddenly competing for supply. What happens to price when demand spikes and supply is racing to catch up? Price goes back up. Not as high as during the war, but higher than people expect. Exxon's CEO said it directly in an earnings call. If the war ends and strategic reserves have been depleted, the rush to replenish them will cause a surge in market demand, driving prices up again. That's scenario 1. Scenario 2 is even darker. Iran's oil infrastructure may be permanently damaged. Iran was producing roughly 3.3 million barrels per day before the war. Those wells didn't just pause, some of them were forced to stop production entirely. Iranian engineers are now having to shut wells down in ways that could take years to reverse. If Iran can't come back online quickly, the global oil market has a structural supply hole in it for years. That means oil settles at a new normal that's higher than pre-war levels, $80, $85, $90 instead of the $68 we saw before all this. This is the scenario that makes the Fed's job impossible. They want to cut rates to stimulate a slowing economy. But if oil stays elevated, inflation stays elevated. And if they cut anyway, they risk the kind of inflation spiral we haven't seen since the 1970s. Scenario 3, and this is the one the World Economic Forum flagged. The global supply chain is being rerouted permanently. Companies are already signing long-term LNG contracts from American producers. Europe is fast-tracking renewables. India is scrambling to find alternative suppliers. The world is quietly decoupling from Middle Eastern oil faster than anyone expected. And that structural shift has massive investment implications. Let's get concrete. I'm going to walk you through 3 scenarios and exactly where the money moves in each one. Scenario A, peace deal in the next 2 to 4 weeks. This is what the market is pricing and hope for right now. When the ceasefire was first announced back in April, the Dow surged 1,000 plus points in one morning. S&P and NASDAQ both rallied. Oil dropped 4 to 6% within minutes of the news. That tells you exactly where money flows. Winner number 1, airlines. This is the fastest, clearest trade. United, Delta, American Airlines. Their single biggest cost is jet fuel, down 20 to 30% with normalized oil. And pent-up summer travel demand is enormous. Delta's CEO was already saying bookings are up 25% year over year, even during the war. Imagine what happens when the war ends and fares stop increasing. Lower costs plus higher demand equals margin explosion. Winner number 2, global shipping and logistics. The 230-plus tankers stuck near Hormuz become a massive release valve. Shipping rates normalize. Companies like Maersk, FedEx, UPS, their surcharges drop. Amazon's margins improve. Winner number 3, Middle East Reconstruction. This one takes a little longer, but the scale is enormous. The Gulf Cooperation Council, Saudi Arabia, UAE, Qatar, Kuwait has suffered infrastructure damage worth hundreds of billions. Iran's oil and industrial infrastructure needs to be rebuilt. Who builds it? Western engineering firms, construction companies, Fluor, Bechtel, Jacobs Engineering, equipment makers like Caterpillar. The analogy here is Iraq after the Gulf War, except the scale is potentially 10 times larger. Winner number 4, tech and semiconductors. This is the risk-on trade. When geopolitical fear drops, risk appetite comes back. Money that was hiding in cash and gold flows back into growth assets. The Nasdaq already showed you this. It rallied hard on every ceasefire headline. AI infrastructure build-out, semiconductors, the secular trend doesn't stop for a war. Scenario B, prolonged conflict, 3+ more months. Oil stays elevated. $110 to $140 a barrel. The Fed stays frozen, can't cut, scared to hike. Consumer spending grinds lower. Recession risk rises. Where does money go? Energy sector E. TFs, XLE. Exxon, Chevron, Pioneer Natural Resources. High oil equals high profits. Simple math. Defense stocks. Raytheon, Lockheed, Northrop. Every week of conflict equals more defense spending globally. Commodities oil isn't the only thing affected. Qatar and Kuwait produce 45% of global traded sulfur. Sulfuric acid prices are up 30% since the war started. Tungsten, critical for semiconductors and military applications, has tripled in price since December 2025. Fertilizer prices are moving. Food prices follow. The play here is a diversified commodities basket. Scenario C, peace plus oil stays high. The nightmare. This is the scenario nobody wants to bet on, but you should be hedged for. Peace happens, but structural supply damage keeps oil at $80 to $90 long term. The Fed is stuck. Inflation doesn't go away. Where does money go? Real assets, energy infrastructure, pipelines, midstream MLPs. These are essentially toll roads on the oil economy. They make money whether oil is at $60 or $120 as long as volume flows. Clean energy. And here's the irony of this whole crisis. Every government on earth is looking at what just happened and saying, we cannot be this dependent on a single choke point. The IEA literally said after this crisis that it's accelerating the global energy transition. Solar, wind, battery storage. The structural case just got 10 times stronger. NextEra Energy, First Solar, Brookfield Renewable. These weren't war plays, but the war just made their long-term thesis bulletproof. What is your action plan right now? I'm going to make this simple. Step 1, understand the signal you need to watch. One metric, one thing, the price of Brent crude futures. When peace rumors get serious, it drops 2 to 4% instantly. When talks collapse, it spikes. That price is your real-time geopolitical sentiment indicator. It tells you what the market actually believes, not what the news says. Step 2, build a barbell portfolio. On one side, energy exposure in case this drags on. XLE, or direct positions in Exxon and Chevron. On the other side, peace beneficiaries ready to run hard. Airlines, UAL, DAL, AAL, clean energy, ETFs, tech. In the middle, cash. 15 to 20%. Because in this environment, volatility is your friend if you have dry powder. Step 3, don't wait for the announcement. Here's the thing about markets and peace deals. When the ceasefire was announced in April, the Dow spiked 1,000 points before the opening bell. If you waited for the official confirmation to buy airlines, you missed the first 5 to 8%. The market prices in probability, not certainty. You don't need 100% confidence that peace happens. You need to be positioned before the market's probability estimate shifts. Step 4. Think about what this means for inflation in your life. Even if oil falls back to $80, gas probably stabilizes around $3.40 to $3.60 a gallon. That's better than now, but still higher than 2 years ago. That means inflation is sticky. That means the Fed keeps rates higher for longer. That means your cash in a high-yield savings account is actually working for you. That means floating rate debt, home equity lines, variable rate mortgages is still risky. Nail down your fixed rate exposures. Keep some cash working at 4 to 5%. That's not exciting, but it's real. Let me leave you with this. In 1973, the Arab oil embargo triggered an energy crisis that lasted 2 years. Inflation hit 12%. Unemployment spiked. A recession hit. Most people just suffered through it. They complained at the pump, cut back on spending, and hoped it would end. But a small group of people, investors, entrepreneurs, analysts, looked at the same crisis and saw a restructuring of global capital. They positioned in energy, in defense, in alternatives, and when the crisis ended, they came out the other side wealthy. That's not callous. That's how capital markets work. Every crisis is a redistribution of wealth. The question is just, are you on the giving end or the receiving end? We are living through the biggest energy supply shock in history. The IEA said so. The Fed is reacting to it. Wall Street is priced around it. And somewhere in the next few weeks or months, this resolves. When it does, $20 trillion in global capital repositions overnight. You now understand the structure of where it goes. You understand the three scenarios. You understand the signals to watch. Most people won't do anything with that. I hope you're not most people. If this video helped you think about this differently, hit the like button. It genuinely helps more people find this. And if you want me to go deeper on any of these specific trades, airlines, clean energy, the Reconstruction play, tell me in the comments. Subscribe. I'll see you there.